My portfolio, the hidden portfolio, was up 19.74% in 2023. And so far this year, year to date, it is up 37.11%. The S&P 500 rose more than 24% in 2023, and in this calendar year, it is up 25.89%. In this video, to round off the year, I wanted to share with you some of the best investment advice I've learned from some of the greatest investors of our time. This advice has helped me carry through and have a strong 2023 and an even stronger 2024. I will be sharing this advice with you, hoping that you will be taking it on to your investment journey in 2025 and in the many years coming onwards. So sit back and enjoy, and let's hear from the greatest investors.
Rule number one, never lose money. Rule number two, never forget rule number one.
McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. CocaCola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. Another one you hear all the time, it's $3, how much can I lose? I've had people call me up saying, I'm thinking of buying the stock at 3, how much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3, how much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it. So I have no idea when the market's going to go down, and when it's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we're going to have a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I remember anybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're in a recession in 85. In 85, they said we have a recession in 86. In 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87.
They said for sure we'll have a recession in 88, and they said 89 for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And all you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people building too many hotels, I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff to get a better average. I conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People were worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, you know, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, you know, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? I mean, you get under your desk. I never thought even then that was a particularly good thing to do. You know, they'd blow whistles, some people in a hat would all get under our desk, you know. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, the century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, and they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And that we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. There's a company with a 20% savings rate, incredible workforce, incredible productivity, and people are saying we're going to have a depression because Japan's going to collapse. And they had, you know, on their prayer list, they lowered Mother Teresa and crippled children, and they were praying for Japan at night. You know, it's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends and we're going to have a depression. Or the Great Depression. We're going to have the Great Depression. I never could quite understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming. But all these countries, and now I understand, you know, these are called then they were called less developed countries. Now, we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's, in fact, the other day I heard the politically correct term for somebody that's overweight is laterally challenged. That's so there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, you know, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions. Study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. There's a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, here's this great company, great record. If it ever gets below 100, just buy every share. And it did get below 100. A lot of people bought on that basis, saying, look, it's gone from 135 to 100. It's now 95. What a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now, fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. You need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product that you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product, and they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you'd worked in the auto industry, let's say you're an auto dealer the last 10 years, you would have seen Chrysler come up in the minivan. You've seen, if you're a Buick dealer, a Toyota dealer, Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of five-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it. And they have incredible edges. People have big edges over me. They work in the aluminum industry. I see aluminum industries coming down, inventories coming down 6 straight months. They see demand improving. In America today, you know, it's hard to get an EPA permit for a bowling alley, never mind an aluminum smelter. So you know when aluminum gets tight, you just can't build 7 aluminum smelters. So when you see this coming, you can say, wait a second, I can make some money. When an industry goes from terrible to mediocre, the stock goes north. When it goes from mediocre to good, the stock goes north. And it goes from good to terrific, the stock goes north. There's lots of ways to make money in your own industry. You can be a supplier in the industry, you can be a customer. This thing happens in the paper industry, it happens in the steel industry. It doesn't happen every week, but if you're in some field, you'll see a turn, you'll see something in the publishing industry. These things come along, and it's just mind-boggling, people throw it away.
I'd take the example of one investment that Warren Buffett and Charlie Munger made, which was the investment in CocaCola. And I wanted to go through the models they used when they made this investment. So there was no spreadsheet ever created when they did the Coke investment. From then till today, it's been about almost 30 years since they made the investment. They have no analysts or associates or anyone who helps them. I don't even believe they made much in terms of notes when they made the investment, but they thought very deeply about it. And for most investments, if you can't do the math in your head, then it should be an automatic pass. So there was no DCF model run for Coke. There was no numbers-based models. I mean, they had some numbers in their mind, but I don't think they ever reduced them to paper.
Stocks sell at silly prices from time to time. Most stocks at one time or another sell at very silly prices. And it doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it. I mean, I figured out very early, you don't have to be that smart in this business, which is fortunate, but you do have to have the right temperament. And you have to be able to ignore what other people are saying and simply look at the facts and decide, is this stock which is selling at X worth 2X? And occasionally you'll find things like that. And when you don't find them, you don't do anything. So that's my generalized stock tip, no names. Is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, you can do your income tax on it. I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, you know, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy, too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I've formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570,000,000. So annually, $6,570,000,000 from 1 penny. Do you think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future. But that's not the world changing doesn't, or new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. And it's that. And I would say that, well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things. And the reason they do it to some extent is because they can get money from other people so much easier than when we started. So you could start 10 or 15 dumb insurance companies in the last 10 years, and you could become rich if you were adroit at it, whether the business succeeded or not, and the underwriters got paid, and
all of these economists with 160 IQs that spend their life studying it. Can you name me one super wealthy economist that's ever made money out of securities? I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments, and he did very well. It's an interesting history. But if you look at the whole history of them, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
Old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. For making an investment and laying out money now is to get more money later on, right? That's what investing is all about. If you buy CocaCola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks searching out unusual, mispriced opportunities. But, you know, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans, or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And they're really, I mean, we have been thumb suckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little, and we waited around hoping we would get more at the price we originally started. There can be a lot of things, but those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook.
Yeah, well, Ben Graham said long ago that you're neither right nor wrong because people agree with you or disagree with you. In other words, being contrarian has no special virtue over being a trend follower. You're right because your facts and reasoning are right. So all you do is you try to make sure that the facts you have are correct, and that's usually pretty easy to do in this country. I mean, the information is available on all kinds of things. Internet makes it even easier. And then once you have the facts, you got to think through what they mean. And you don't take a public opinion survey. You don't pay attention to things that are unimportant. I mean, what you're looking for is things that are important and knowable. If something's important but unknowable, forget it. I mean, it may be important, to know whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. It may be all kinds of things. But
Yes, volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk.
Hey guys, just a quick break. I just wanted to ask you guys if you could kindly subscribe, like, comment, and share the video. It really helps the channel a lot, especially if you're enjoying the content here and you're looking forward to see more content. Like and subscribe would be very much appreciated. Thank you. Now back to the video.
As a general matter, as a one piece of specific financial advice, I would say, avoid credit cards. Just forget about them. We're in various businesses that issue credit cards. The American public loves credit cards. But if you start revolving debt on credit cards, you're going to be paying 18 or 20%. And you can't make progress in your financial life going around borrowing money at 18 or 20%. You can make a lot of money by lending it out at 18 or 20% over time. If you can find anybody that's good that will borrow from you. But you don't want to be on the side of the equation that's always behind in life. You know, I was lucky. I'd saved about $10,000 by the time I got out of school. That $10,000 was really worth millions I might have earned later on, because after you get a family and everything, the expenses roll in. But those were my tools to work with, but it was only because I was ahead of the game. If you're behind the game by $10,000 at some point and paying 18 or 20% interest on it, you will never, you'll never get out of it. So the trick, I've got a partner that says, all I want to know is where I'm going to die, so I'll never go there. And that's true in financial matters as well. You want to figure out where you don't want to be ahead of time and avoid that. And I get about a dozen letters a day from people who are having terrible problems. And there are two reasons why they have terrible problems. One is a number of them have had health problems of some sort. I mean, they have really been hit by or somebody in their family has been hit by some kind of catastrophic illness. And that is it's a terrible thing to happen to any family. And they they run up bills they can't pay, and really only society can solve that one in terms of protecting people against that. That's just plain bad luck. But the other one is from people who run up credit card debt, and they're facing bankruptcy, or they've been through bankruptcy once before, and they owe a whole bunch of money, and they can't even pay the interest, let alone pay any principal. And half of my letters come from people like that, and that problem is avoidable. Catastrophic illness is not, but credit card debt is something you bring on yourself, and it's way better, it's way easier to stay out of trouble than to get out of trouble financially. And I will guarantee you, if you run up big credit card debt, you will be in trouble probably the rest of your life in terms of your financial situation. On the other hand, if you get ahead of the game, even it's on a very modest scale, so that money is coming in from investing, and people owe you money, or equities owe you ownership, you'll be way ahead of the game compared to paying it, always paying your creditors every month. So my advice to you is, if you can't pay for it, don't buy it, and get yourself in a position where you can pay for anything, and then we'll be glad to see you at Borshon.
All kinds of people watching this that are long Bitcoin, and there's nobody that's short, and nobody wants their windpipe stepped on. And I don't blame them. I don't like people who step on my windpipe. But I would say this, that if the people in this room owned all of the farmland in the United States, and you offered me a 1% interest in it, and you said, for a 1% interest in all the farmland in the United States, pay our group, well, let's see, 10 trillion, pay us this bargain price, $25 billion. I'll write you a check this afternoon, $25 billion, now I own 1% of the farmland. If you tell me you own 1% of the apartment houses in the United States, and you offer me a 1% interest, so I'll have a 1% interest in all the apartment houses in the country, and you want whatever it may be for it, then call it another $25 billion or something. I'll write you a check. It's very simple. Now, if you told me you owned all of the Bitcoin in the world, and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, they have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. What? Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now, net, if you look at it, a lot of commissions have been paid, and there's all kinds of frictional costs that are very real that somebody has paid to a bunch of people who facilitate this game. But whatever one group of the public has taken out, or one group of owners, has come in from other people. It's other people have entered the room and they move money around, but there's no more money in the room. It's just changed hands with a lot of maybe fraud and costs involved, and a whole bunch of things. You lose, you forget the numbers or forget the equation.
Venture firms like Sequoia and others.
It pains me that in my own country, I see people that were once regarded as very reputable people helping these things exist, promoting their use and so forth. This is a very, very bad thing. The country did not need a currency that's good for kidnappers and so on.
What do you think happened? Because there are a lot of big names, a lot of people and firms that you might not have anticipated.
That's what depresses me. There are people who think they just got to be on every deal that's hot, and they don't care whether it's child prostitution or Bitcoin. If it's hot, they want to be on it. I think that's totally crazy. Reputation is very helpful in financial life. And to destroy your reputation by associating with scumballs and their scumball promotions is a huge mistake.
Do you think those companies did any due diligence, or what happened?
I think they actually mean well, though that you're seeing a lot of delusion. It's partly fraud and partly delusion. That's a bad combination. I don't like either fraud or delusion. And the delusion may be more extreme than the fraud.
Delusion, how so?
Nobody's going to bet a new thing that every 12-year-old kid can be a billionaire or something. He just calls it Munger Coin. He starts trading it or something. It's crazy. It's demented.
Munger, of course, is not quick to accept the value of the new technology, like the blockchain, over the potential danger of a speculative, risky, or even, as he calls it, demented venture like cryptocurrency.
Once you've got a good idea, it's much easier to push that to wretched excess. That's why good ideas carried to wretched excess become bad ideas. And once you get that concept in your mind, of course, it's always going to be some good idea. Nobody's going to say, I've got some that I want to sell you. Like the blockchain. It's high octane blockchain. Blockchain is a new good thing that's come up, like fairy dust.
You do have a way of putting it very precisely, Charlie.
I don't think there are good arguments against my position. I think the people that oppose my position are idiots. And so I don't think there is a rational argument against my position. This is an incredible thing. Naturally, people like to run gambling casinos where other people lose. And the people who invented this crypto crapo, which is my name for it, and sometimes I call it crypto crapo, and sometimes I call it, well, crypto shit. And it's just ridiculous that anybody would buy this stuff. And it isn't. You can think of hardly nothing on earth that has done more good to the human race than currency, national currencies. They were absolutely required to turn man from a goddamn successful ape into modern successful humans in human civilization. Because it enabled all these convenient exchanges. So if somebody says, I'm going to create something that sort of replaces the national currency, it's like saying I'm going to replace the national air. You know, it's asinine. It isn't even slightly stupid. It's massively stupid. And of course, it's very dangerous. And of course, the governments were totally wrong to permit it. And of course, I'm not proud of my country for allowing this crap, what I call the crypto it's worthless, it's no good, it's crazy. It'll do nothing but harm. It's antisocial to allow it. And the guy who made the correct decision on this is the Chinese leader. The Chinese leader took one look at crypto and he says, not in my China. And boom, there isn't any crypto in China. He's right and we're wrong.
I think value investing is still relevant. And what about passive investing?
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. Some people think that value investing is you chase companies which have a lot of cash and earn a lousy business or something. But I don't define that as value investing. I think all good investing is value investing. It's just that some people look for values in strong companies and some look for values in weak companies. But every value investor tries to get more value than he pays for. What is interesting is that in wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. But of course, everybody's looking for the same thing. And the trouble with it is you will find when you get into those good businesses, places picked over and analyzed as American stocks are. You can imagine the amount of time spent thinking about American stocks. And you will find, by and large in America, if it's really a great business, it's at least 25 times earnings and maybe 30 or 35 or something. So that makes it much harder, of course, because if something goes wrong, you can lose a lot of your investment. And of course, that's what makes investment so difficult, is the fact that the good businesses don't stay cheap. You got to somehow recognize a good business before it's recognizable as a good business. That's very hard to do. Some people get good at it, but not many. I don't think I would want 95% of the people who are America's professional asset managers, I wouldn't want working for me.
Really?
I think it's that hard. I think you need to be in the top 5% to have a reasonable chance. It's very difficult. Now, it's not difficult to just buy an index fund and sit on your ass. That's the great default position.
Your assets?
And by the way, that's if you look at the Daily Journal Corporation. We just put in a 401k plan. And so I always knew from the very first, when I was a little boy, that the opportunities that were important that were going to come to me were few, and that the trick was to prepare myself for seizing the few that came. This is not the attitude they have at a big investment counseling thing. They think if they study a million things, they can know a million things. And of course, the result is almost nobody can outperform an index. Whereas I sit here with my Daily Journal stock, my Berkshire Hathaway stock, my holdings in Lilu's Asian fund, my Costco stock, and of course I'm outperforming everybody. And I'm 95 years old, and I practically never have a transaction. And the answer is I'm right and they're wrong. And that's why it's worked for me and not for them. And now the question is, do you want to be more like me or more like them? The idea of diversification makes sense to a point. If you don't know what you're doing and you want the standard result, and not be embarrassed, well, of course, you can widely diversify. Now, nobody's entitled to a lot of money for recognizing that because it's a truism. It's like knowing that 2 and 2 equals 4. But the investment professionals think they're helping you by arranging a diversification. An idiot could diversify a portfolio, or a computer for that matter. But the whole trick of the game is to have a few times when you know that something is better than average, and invest only where you have that extra knowledge. And then if you get just a few opportunities, that's enough. And what the hell does you care? You own 3 securities and J.P. Morgan Chase owns 100. You know, what's wrong with owning a few securities? Warren always says if you lived in a growing town and you owned stock in 3 of the best enterprises in the town, isn't that diversified enough? The answer is, of course it is. They're all wonderful places. And that Fortune's formula, which got so famous, which was a formula to tell people how much to bet on each transaction if you had an edge. And of course, the bigger your edge, the more close the transaction was to a certain winner, the more you should bet. And of course, there's mathematics behind it. But of course it's true. It's perfectly possible to buy only one thing because the opportunity is so great and such a cinch, or only 2 or 3. So the whole idea of diversification when you're looking for excellence is totally ridiculous. It doesn't work. It gives you an impossible task. What fun is it to do an impossible task over and over again? I find it agony. Who would want to do it? And I don't see why. My father had a client. He was a lawyer in Omaha. He had a client whose husband had a little soap company. And the guy died, and my father sold the soap company. This woman was one of the richest people in town in the middle of the Depression. And what she had was a little soap company in a big mansion in Omaha's best neighborhood. And they sold the soap company. She had a mansion in the best neighborhood and $300,000. But $300,000 in 1930-something was an incredible amount of money. A little hamburger was a nickel, a big hamburger was a dime, and the all-you-can-eat cafe in Omaha would feed you all you needed to stay alive for 2 bits a day. I mean, $300,000. Well, she didn't hire an investment counselor. She didn't do anything. She's a wonderful old woman. And she just took that and she divided it into 5 chunks. And she bought 5 stocks. I remember 3 of them because I probated her estate. And it was, one of them was General Electric, one was Dow, one was DuPont, and I forget the other 2. And then she never changed those stocks. She never paid any advisor. She never did anything. And she bought some municipal bonds. She never spent her income. And she bought some municipal bonds from time to time with the incomes. By the time she died in the 50s, she had $1.5 million. No costs, no expenses. And I said, how did you decide to do that? And she said, well, she said, I thought electricity and chemistry were the coming things. She just chunked it all in and sat on her ass. I always liked that old woman. My kind of a girl. But it's rare. You know, but if you stop to think about it, think of all the expense and palaver that she didn't have to listen to, and all the trouble she avoided, and 0 costs. And of course, what people don't realize, because they're so mathematically illiterate, is if you make 5% and pay 2 of it to your advisors, you're not losing 40% of your future. You're losing 90%. Because over a long period of time, that little difference causes a 90% disadvantage to you. So it's hugely important for somebody who's a long-term holder not to be paying a big annual toll out of the performance. And of course, there are a few big-time advisors now who are using indexation very heavily. And of course, they're prospering mightily. And of course, every time they get somebody, it's just agony for the rest of the investment counseling business. If you take the modern world, where people are trying to teach you how to come in and trade actively in stocks. Well, I regard that as roughly equivalent to trying to induce a bunch of young people to start off on heroin. It is really stupid. And when you're already rich, to make your money by encouraging people to get rich by trading. And then there are people on the TV, another wonderful place. And they say, I have this book that will teach you how to make 300% a year. And all you have to do is pay for shipping, and I will mail it to you. How likely is it that a person who had suddenly found a way to make 300% a year will be trying to sell books on the internet to you? And it's ridiculous. And yet, I've described modern commerce. And the people who do this all day think they're useful citizens. The advertising agents that invent the lingo. And so in insurance, they say, the two people who shifted from Geico to the Glotz Insurance Company saved $400 each. What they don't tell you is there are only two such people in the whole United States, and they were both nuts. But they mislead you on purpose. And I get tired of it. And I don't think it's right that we deliberately mislead people as much as we do. Let me tell you another story that I think is an interesting one about the modern life. But this goes back to a different time. And this man has this wonderful horse. And it's just a marvelous horse. It's got an easy gait and good looking and everything. It just works wonderfully. But also occasionally just gets so he's dangerous and vicious and causes enormous damage and trouble and breaks arms and legs for his rider and so on. And he goes to the vet and says, what can I do about this horse? And the vet says, that's a very easy problem and I'm glad to help you. He says, what should I do? And the man says, the next time your horse is behaving well, sell it. Well, think of how immoral that is. And haven't I just described what private equity has to do? When private equity has to sell something that's really troublesome, they hire an investment banker. And what does the investment banker do? He makes a projection. You can't, I have never seen such expertise in my whole life as is created in making projections in investment banking. There is no business so lousy it can't get a wonderful projection. But is that a great way to make a living, to have phony projections and use it to make money out of people you look right into the eyes of? I would say no. And by and large, Warren and I, we never tried to make money out of stupidity of our dumb buyers. We tried to make money by buying. And if we were selling horse shit, we didn't want to pretend it was a cure for arthritis. And I think it's better to go through life our way instead of theirs. And I think it's always been this way. I think there's always been chicanery. Think of the carnivals, the carny operator. Think how much trickery there is in a carny operation. And people just seek out the weaknesses of their fellow man and take advantage. And you have to get wise enough so you avoid them all. And you can't avoid them if they're in your family. I have no solution to that one. But where you have a fair choice, there are just so many people that should be avoided. My father had this best friend and client. And he also had this other client who was a big blowhard. And he was always working for the big blowhard, and he wasn't ever working for his wonderful client whom I admired. And I said, why do you do this? And he said, Charlie, you idiot. He says, the big blowhard is an endless source of legal troubles. He's always in trouble, overreaching and misbehaving and so forth. Whereas Grant McFadden treats everybody right, the employees, the customers, everything. And he gets involved with some psychotic, he walks over there and makes a graceful exit immediately. So a man like that doesn't need a lawyer. And my father was trying to teach me something, and it really worked. I spent my whole life trying to be like Grant McFadden. And I want to tell you, it works. It really works. Peter Coffin is always telling me if the crooks only knew how much money you could make by being honest, they'd all behave differently. Warren has a wonderful saying I like. He says, if you take the high road, it's never crowded. and it's worked. Take the Daily Journal Corporation. We made quite a few millions of dollars out of the foreclosure boom because we published legal notices and we dominated.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get. One of my favorite tricks is the inversion process. And I'll give you an example. When I was a meteorologist in World War II, they told me how to draw weather maps and predict the weather. But what I was actually doing is clearing pilots to take flights. And I just reversed the problem. I inverted. I said, suppose I wanted to kill a lot of pilots. What would be the easy way to do it? And I soon concluded that the only easy way to do it would be to get the planes into icing the planes couldn't handle, or to get the pilot to a place where he'd run out of fuel before he could safely land. So I made up my mind I was going to stay miles away from killing pilots by either icing or getting them into locked-in conditions when they couldn't land. I think that helped me be a better meteorologist in World War II. I just reversed the problem. It's amazing how if you just get up every morning and keep plugging and have some discipline and keep learning, and it's amazing how it works out okay. And I don't think it's wise to have an ambition to be president of the United States or a billionaire or something like that, because the odds are too much against you. Much better to aim low. I did not intend to get rich. I wanted to get independent. I just overshot. And and by the way, while you're clapping, some of the overshooting was accidental. There's a big, you can be very deserving and very intelligent and very disciplined, but there's also a factor of luck that comes into this thing. And the people who get the outcomes that seem extraordinary, they're the people who have discipline and intelligence and good virtue, plus a hell of a lot of luck. Why wouldn't the world work like that? So you shouldn't give credit for the unusual. A lot of the people, a friend of mine said about a colleague of his in his fraternity, he says, old George was a duck sitting on a pond and they raised the level of the pond. There are a lot of people that just luck into the right place and rise, and there are a lot of very eminent people who have many advantages, and they've got one little flaw or one bit of bad luck, and they're mired in misery all their lives. But that makes it interesting to have all this variation.
Well, Charlie, on behalf of everyone,
talked about that called the three-legged stool. And so the first leg is understanding exactly what the nature of the business is and what kind of returns on the owner's capital does it produce. And then we want to see if it has the ability to do that for a long time. If the runway is wide and long, we say. So what's causing that above average rate of return to exist? What's going on? What's unusual about that business? So the second leg that we look at is the people who run the business. And we're very focused on the skill level of the people who run the business and look at their record and whatnot. But we also want to know that they're acting in the best interest of all shareholders. That is, we see that what happens in the business happens to us on a per share basis. And then the last leg of it is the issue of reinvestment. So we examine how it is they have reinvested free cash flow in the past, what the outcomes have been, and they rarely break those out, by the way. We have to do our own work. And then what the opportunity for reinvestment going forward is, because the fact that they can reinvest all of their free cash flow to earn above average returns enhances our compounding effect. And that's what we're after at the end of the practice.
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on, and oftentimes it is not completely obvious as to what it is that's going on. A great example of that would be a company like MasterCard or Visa.
Uh-huh.
They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
Okay.
I mean, it's just that simple, you know. And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates. So what they do with their free cash flow is they buy in shares, they pay a cash dividend, they make small acquisitions in technology around their space, but it's a challenge to utilize all the free cash they generate. And unlike our ideal company is one that can keep reinvesting and earn outrageous returns on capital.
Right. One of the things, John, part of the
say, I'm not sure we are avoiding it. Now,
and the other part of my question should be, when I talked to you in 2014 that you had 30 holdings, you're now down to 17, you've got a ton more money. Shouldn't you have more holdings? So go ahead.
Right. So we always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that deviates positively or negatively from average. And I think
so. You're flipping coins, Chuck. You didn't know that. Okay.
So,
okay.
But that's what I mean by
so that's the philosophy.
So it's really not about our AUM. It's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
In 2014, if we had 30 or 35 holdings, we would have been at that point in time less confident in those names than we are in the 17 holdings today.
Okay.
So if you see our holdings go to 35 again, you should just understand that it means we are less confident in the characteristics of the group as a whole, and that's why we have it spread out. And then the concentration, pure concentration, is we want to have as much money invested in the great businesses as we possibly can, because our return will come from their good experience. We will be riding on the back of those great businesses. So that's why we want to have all this, our capital concentrated in those things.